if you want to beat the game, you have to be able to affect the game, and you have to know the game inside out. To do that, you have to be on the inside and not the outside.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome to the Phil Bach Podcast. We have a great show today. On the line with me is Liam Vaughan. Liam is the author of the book Flash Crash, A Trading Savant, A Global Manhunt, and the Mysterious Market Crash, the most mysterious market crash in history. Liam Vaughan is also a senior reporter with Bloomberg and Businessweek magazine in London. He's the author of The Fix, which tells the inside story of the LIBOR scandal. Vaughan has covered financial markets for more than a decade. In 2013, he led a team of reporters who uncovered a global conspiracy to manipulate the $5 trillion Forex market, sparking investigations on 3 continents and resulting in $10 billion of fines for including JP Morgan, Citigroup, Barclays, and UBS. He was awarded the Gerald Loeb Award for Excellence in Business Journalism in 2014 and the Harold Wincott Prize for the Best Financial Journalism in 2013. Liam, thank you for coming on the podcast.
Thanks for having me, Phil. It's a pleasure.
So I really enjoyed this book, and like we were just talking about, the detailed, wonky market structure world is so incredibly complex and fragmented in this day and age that there are, all but a handful of people globally, I believe, that really truly understand it, that really grasp it from all different sides. And this was, such an interesting book because you had to not only go deep into those worlds and understand it and then explain it in a way that is, relatable and interesting to people, but you're also dealing with the personalities that were involved, which were, not your typical prototype of villains and heroes that you'd see in a typical story. So, it was a great book. I really enjoyed it and really excited to share a little bit of it with the audience. Let's start just from a super high level, for anyone who might not be familiar, what was the flash crash?
So on May 6th, 2010, it was the kind of midst of the Eurozone crisis, and markets were extremely volatile at that period in time. You had Greece and the other kind of pigs, as they were called, on the kind of cusp of bankruptcy. You had governments propping up banks. It was the day of the UK general election. So you had all these kind of swirling macroeconomic conditions. And then that afternoon at 1:41 p.m. Central Time, the bottom just suddenly fell out of the market. And within the space of 4 minutes, the S&P 500 had plummeted 5%, which was the fastest fall in the history of the market. The move was so fast that the CME at that point stopped the market for 5 seconds, and you had the entire sort of financial firmament just watching on, wondering what the hell has just happened. After that, you start to see individual stocks behaving really weirdly. Some stocks were trading at like fractions of a cent. Others suddenly were soared up to like $100,000. And then the weird thing was that within half an hour and shortly after the CME had unfrozen the market, prices started to return to close to where they had started before the bottom fell out. So about 30 minutes later, you could have looked at the market and it would have been quite hard to even know what had just gone on. But, temporarily, it was this huge and very destabilizing event in the market and led to big questions about what the hell had just happened, why had it happened, and more importantly, would it ever happen again?
Yeah, and I think part of what the flash crash truly exposed was how thin the veneer of liquidity is in the markets. Everyone just assumes these markets are so liquid, they trade like water throughout the day with massive amounts of capital, but in reality, most of that liquidity is just high frequency traders or Delta One arbitrage mechanisms that can vanish. If market conditions tell the owners of those algorithms to vanish, they can vanish in an instant. And just like that, all of liquidity is gone. So, we're now 10 years past the flash crash. People still talk about it. I don't know if there's been a lot that's happened market structure wise to solve it. There have been some attempts and some initiatives around the edges that have done so. And we have we've seen like mini flash crashes since, but nothing quite as intense as this one since. So it's still very, very topical. And when people talk about market structure risks, I think this is really what people are thinking about in this day and age. So, I mean, for you as a journalist, what was it about the flash crash that was fascinating, that was interesting, that drew you in, that made you want to explore it and ultimately write a book about it?
So my interest in the story really came about 5 years later when a guy trading out of a bedroom in his parents' house in a place called Hounslow, which is a pretty rough and ready suburb on the outskirts of London. His house is literally directly below the Heathrow flight path. So every 5 minutes, nobody can have a conversation. And I was working in the office at Bloomberg, covering banks and covering white collar crime. And this guy, Navinder Singh Sarao, got arrested. And it was just such an odd story. The idea that a kid effectively trading using a home PC could have helped cause, this global financial event, that aftershocks were felt everywhere and up to the highest levels of government. And so, for me, it was less about unearthing what had exactly happened in the flash crash at that point. It was really just understanding, well, who the hell is this guy and how did he get in this position where he was hauled out of bed by the FBI?
And ultimately made the scapegoat. I mean, you would think that if there was some nefarious activity or some ill intention that broke the markets, that it would have been done by some, criminal mastermind or some entity that's got, vast resources to be able to pull it off, when in fact, the blame ended up falling on Nav Sarao. So who is Nav Sarao?
Nav Sarao is a guy who had quite a normal upbringing in quite a working class neighborhood. He liked football, absolutely obsessive about football, played in the park with his mates every week, loved computer games, bit of a kind of cheeky guy, got a bit of an accent, wears tracksuits, loves McDonald's. If you met him, you'd be amazed what he ended up being famous for. One day in 2003, he was unemployed. He'd gone to university, fairly standard university, and there was an advert in the local newspaper, and it said, "Wanted traders, must work well under pressure," which, let me tell you, isn't how they typically request traders at JP Morgan or Goldman Sachs. So, he applies for this job, and it's this out-of-town arcade, which is literally above a supermarket. And it was one of the first, I guess, arcades that sprung up in the aftermath of the closure of the futures pits, when suddenly trading was entirely migrated to the screens. And suddenly guys like Nav, who had a background in gaming, would turn out an incredible ability to both pass and process information and to remember information and data. So, he took one of the positions at this trading arcade, and within a fairly short space of time found that he was just incredibly good at trading. I mean, he was specifically trading a style known as scalping. So he was looking at the order book, at orders coming in and leaving the market and trades being consummated. And he would use that, his kind of understanding and knowledge of the order book, to predict which way the market was about to move. And he would get in and get out, make a tick, make another tick. And he would do that throughout the day, small sums, but do it often enough, and you can make a lot of money. And Nav turned out to be incredibly gifted at scalping. And within the space of 5 or 6 years, he was worth £2 million from a complete standing start. So that's where the sort of story begins, this sort of growth of this trader. Yeah.
Yeah, and you use the analogy of gaming. You use the analogy throughout the book about how, Nav especially, but the whole thing was like a video game, and how Nav felt like he was leveling up. He was very dispassionate. He wasn't materialistic. He didn't spend the money. He didn't seem to really care about the money. He was playing a video game and just leveling up his size, and viewed much of the market as a video game. And I think, honestly, that is a pretty fair way of looking at it. It's a fair way of looking at what the market has become. I mean, you get into a lot of the complexity of market structure and talking about a lot of the different order types. And, this guy, Nav Sarao, was competing against high frequency traders and firms that had infinitely more resources than he did, that were using all sorts of sophisticated order types in an effort to do something no different than what he was trying to do. And, to get a little bit of edge to make a short-term profit. Neither side of the trade is doing any fundamental analysis or making a long-term investment here. This is just the video game of short-term trading. What he ended up being convicted for was the crime of spoofing. And I think, the case could be made that much of what his competitors were doing as well, really very, very, very similar, if it could be distinguished at all. So, before we talk too much about that, help me define, what is spoofing?
So spoofing was like a brand new offense that came in with Dodd-Frank in 2011. It's quite a simple definition. It's basically, you're not allowed to place orders that at the time you place them that you intend to cancel. And the reason it became more of an issue is that as trading sort of migrated onto screens, and more of it was carried out by algorithms that were passing information from the order book to try and predict which way the market was going to move, it suddenly dawned on people like Nav that if you could deceive your competitors about supply and demand, then you could potentially get the market to move on a short-term basis in small increments, but in ways that you could then capitalize on. So, as it pertains to this story, Nav was kind of ticking along very nicely, making lots of money. By 2008, 2009, he was worth, I think it was £15 million. So pretty successful for a day trader in a very short space of time. But he gets increasingly frustrated by the arrival and the emergence of high frequency trading firms that go from being a small part of the market to dominating the futures market and indeed stock markets over a few short years. And for Nav, we've all read Michael Lewis's book. We've heard about the complaints about HFT and what they bring to society and how they make their profits at the expense of other people. But to be brutally honest, Nav didn't really care about that stuff. He just cared that he wasn't able to compete anymore. He couldn't pass the order book and trade more quickly and more effectively than a robot. So at that point, he had a choice. He could either sort of quit the market and hang up his mouse, or he could try and fight back. And so what Nav does is he decides to build an algo of his own that will trick the algos and temporarily nudge the market that he wants them to. So in its original incarnation, this machine, this kind of rudimentary spoofing machine, would fire huge sell orders into the market far enough away that they're unlikely to ever be hit, and then watch the market react to that and then trade around it. And he would do that for a couple of minutes, a minute at a time, and the market would move, and he would profit from that move. And he quickly gets to such a size, like he's trading hundreds of lots, that even like making a couple of ticks suddenly starts to mean serious money for him.
And that's all it took. A few ticks in the E-mini
Yes.
futures market, which led to disruptions in ETFs, which led to single stocks. So at least, for long enough for market makers to turn off their trading in real time and say, all right, let's figure out what's going on. And as soon as they saw that there was, in fact, nothing, related to market price going on, turn them back on. And, that's really all it took, right? Is that fair to say?
Yeah.
Yeah. So, and ultimately, the assertion that Nav was responsible for the flash crash, the assertion is such that all it took was, a little spoofing in the E-mini contracts, which, was enough to scare market makers out to pull their algos, which led to them pulling their algos and their pricing models out of ETFs, which led to single stock market makers pulling back and turning off their machines and saying, we're gonna start quoting once we see what's going on. And it took a couple minutes for people to see what was going on, which was nothing, and then turn them back on. And that's really, the assertion that he was responsible. That would be all that he would have done to be responsible.
Definitely. The actual size of his trading was not huge by the standards of kind of major funds or major market entities, but the size of his spoof orders was pretty substantial. But in terms of the flash crash itself, and I'm sure we'll get to that, but it's fair to say that he was active that day and was spoofing large size, but he was also just one of so many other factors that's really difficult to pin it on him exclusively or even like as in the round.
Yeah, and that's something that you don't say one way or the other. You don't editorialize whether he was a scapegoat or not, but you provide a lot of information about what was happening. And there's a few very interesting things to me. One is that it took 5 years for anybody to assign any blame on Nav. It took Chaim Bodik to look at the data and come up with some evidence that it might have been him to blame. But in between, there was the plunge protection team, and first you have trade busts, and you have finger pointing between the CFTC and the SEC and the stock exchanges. Waddell Reed was blamed for a little bit of time. And what did that look like coming out of the flash crash when everyone was trying to point the finger and understand what happened?
Yeah, so the beginning of one of the chapters of my book is a conversation that takes place between this thing called the President's Working Group, which is basically like the head of the CFTC, the head of the SEC, the head of the Federal Reserve, and the Treasurer. So about as senior people in financial markets as you can get. And they all get on a call at 6 p.m. that night and are like, what the hell just happened? And, in terms of the actual impact on prices itself, it wasn't huge. The market bounced back. There were a number of people that did lose their shirt and lost a lot of money. And I sort of detail those in the book. But there was a decision taken at the time by FINRA and the brokers that they would rip up any trades that took place. I think it was 60% outside the price when they sort of went into the flash crash. So in terms of the actual sort of economic impact on the wider system, it was contained, but what it really led to for the first time is a period of real scrutiny over the way that markets had changed, and specifically over the advent and arrival of these high frequency trading firms. Because, for a long time, people would write the occasional article about robot wars or algos turning up or whatever, but nobody had really sort of stopped to say, well, what does it mean if 1 in every 2 transaction passes through the hands of a small, sometimes scantily regulated entity in Chicago? Like, is that safe? What's the fallout from that? And obviously the American government was concerned that it could happen again, and this time it wouldn't bounce back and people would stop investing in the markets and stuff. So there was a real sort of existential crisis, I guess, in financial markets for a period of time. And my book sort of tells the narrative of what happened over the weeks and months that followed. And you're right, basically there's a decision made that there's going to be an investigation, and then there's the CFTC portion of it and the SEC side. And you have both those representatives from both those sides kind of blaming the other, because the crash started in futures and then it kind of migrated to the stock market. But some of the impact was worse in the stock market and some of the anomalies were sort of more extreme. So you have both sides sort of blaming the other. And one of the things it really revealed is that there's criticisms about the fact that there's only one exchange for a lot of financial futures. That carries its own issues. But at least it meant that the regulators could get hold of the data and they could look at what happened to an extent on a trade-by-trade basis. Whereas for the SEC, by that stage, the marketplace had fragmented to such an extent with all these exchanges and all these dark pools. It was literally impossible for the SEC to be able to do an analysis of what had actually occurred in the stock market. So really, you have this kind of like clamoring for answers from the general public and from politicians, like what the hell had just happened? And you have the regulators that are like, not only do we not know, but we've got no prospect of finding out at that point in time. Eventually, on the CFTC side of things, on the futures side of things, when they look at the trade data, they find out that there is this one actor that had placed a very large sell order of E-minis at 1:30 p.m., so 10 minutes before the sort of bottom fell out of the market. And it was this Kansas City pension fund, asset management fund called Waddell & Reed. And Waddell & Reed had been long stocks for a long period of time, but that day, with all the kind of volatility in the market, wanted to hedge its position. So it implemented a 75,000 lot sell order. But the problem was that it didn't put like a base price or a sort of maximum volume or speed with which you wanted to offload this position. So it puts this sell order in at exactly the wrong moment, really. So if you look at the CFTC and the SEC's conclusions of that day, they point the finger quite pointedly at that point in Waddle and Reed's direction, and that was the end of it. Like, there was no mention of a guy spoofing or market manipulation or anything like that for at least another 2 years.
Yeah. It's really amazing how it came back around and so out of the blue. And, when you talk about how hard it is for, the SEC to gather the equity market data, the stock market data. I mean, I can tell you from my personal experience, I was at one of the major stock exchanges at the time, and we spent months and months parsing the data and providing data. I mean, it was request after request after request of organizing data and sending it over to that committee. And, the reason why it's so hard is, a lot of people don't realize that a stock has a primary listing exchange in the US. So Apple is listed on the NASDAQ. However, you can trade it on any exchange. And the primary listing venue typically does about 20 to 25 to 40% of the trading volume of their primary issues of their stocks. So you could trade these things anywhere. That was part of Reg NMS, that you have to execute where the best price is. But what that means is you get what's called fragmentation. And that means that people are quoting all over the place. You have dark pools, you have, all sorts of internalized trading mechanisms. You've got all sorts of exchanges that you haven't heard of in addition to the few that you have. And that fragmentation makes it more difficult to quote. And it also makes it more difficult to understand what's going on in the market. I mean, I'll tell you my story real quick of what happened during the flash crash. I was fairly new at the exchange, and my job was to work with exchange traded fund issuers and market makers. And one of the more notoriously aggressive clients on the ETF side, one of the largest asset managers, is calling every 2 seconds. My managing director is demanding information. My managing director is demanding information. I didn't know anything. I'm trying to figure it out myself, but I'm pretty far removed from technology. And we're, of course, talking to everyone on the trading floor and all the technologists. The ETFs all traded on, or at the time traded on, NYSE Arco, which was the electronic platform, not on the trading floor. And, the people who have the ability to parse the data and understand what's going on in real time, they were caught flat-footed, and they're trying to figure it out in real time. And finally, I get, the best guy, the chief technologist at Arca, to get on the phone with this client. I say, all right, give me 10 minutes. We're going to have him on the phone. So 10 minutes later, we all dial in, and there's, hi, I'm the global head of this, the Americas head of that, the US head of this, reporting to the Americas, reporting to the global, the director, the managing director, the senior managing director. There must have been 20 people on the phone. And I say, okay, well, I have this guy on the phone. He picks up the phone. He goes, Phil, do you want me to fucking figure it out, or do you want me to fucking sit here and explain it to you? Click. And he hangs up. And I'm sitting there on the phone with 20 people. I'm like, so, we'll get back to you when we have a little more information, but then you'd hear the phone in the next office ring, and then the phone in the office after that ring, and you'd hear kind of moving down the hallway, the phone ringing as they tried everyone. I mean, there are very few people, even at the most central organizations in market structure, there are very few people who really have their hand on it, that really understand what's going on. It is all pricing algorithms now that are so incredibly complex that it is beyond the comprehension of one single person. One person can understand an area of it or a part of the market, but the entire market has gotten, so incredibly complex and fragmented that there is no way that, even, going back to 2010 technology, it took 5 years to be able to find some poor sap to pin it on.
Yeah. Well, I think that's part of the reason there is so much skepticism around the HFT industry, because ultimately any industry that turns around and says, you won't understand this, there's no point in me even trying to explain it to you, you won't get it. But let me just tell you that it's good for the markets. It brings liquidity, it makes prices better, and don't worry about what we're actually doing or how we make our money. Just know that it's fine. And, they are kind of lobbying at the highest levels with the highest levels of kind of regulators. And from the book, one of the major tenets of the book is a sort of deep dive into the investigation, both into the flash crash and then into Nav Sarao. And obviously you have different levels of expertise within these financial regulators. But a lot of the people that are bringing the actual cases, the kind of enforcement folks, they're, to a man and to a woman, incredibly intelligent people and well educated, but they're not finance people for a lot of the time. They, more often than not, they're lawyers and they've gone to law school. And so even with the best will in the world, they're constantly not just one step behind, but like half a marathon behind.
Here's a passage from the book that I really loved. And you're telling the story of Senate Banking Committee had a hearing in December of 2010. So it's 7 months later. And you write, about an hour into the proceedings, Senator Jack Reed shifted the conversation from the practical to the philosophical. Quote, the presumption of most people who own a few stocks is that the value of stocks, the liquidity of stocks, is directly a function of their economic value. The same thing with debt instruments and derivatives. One of the issues we have to deal with the proliferation of these algorithmic high-frequency traders, some of these algorithms don't take into account the fundamentals of the instrument, the economic value, the dividends, the status of the municipality issuing them. They are simply saying if enough of these are sold, then we start selling, and if we start selling, then another algorithm kicks in. To the extent that we get further away from the economic values here, does that not only cause concern, but is that something that's good for the economy? It may be a naive question, but I'll pose it. And then Mary Shapiro from the SEC said it's not a naive question at all. It's sort of the fundamental question that we're grappling with.
Yes. And I think that the reason that's striking is because it highlights the real gulf in understanding between finance folk and just the common people. And, what's quite interesting is that at that period in time, there was a real consideration given to whether to spend more money on trying to really understand what different high frequency trading strategies were, whether there should be some kind of increased regulation, whether it was such a great thing that 60-70% of trades suddenly were going through third parties. But ultimately, spoiler alert, nothing really gets done about that fundamental question. And instead, what comes in and the priorities that come in are things like focusing on spoofing. And don't get me wrong, I'm sure that there's arguments why spoofing should be outlawed, but it's just some people might ask whether that's kind of seeing the wood for the trees, really, whether that's the biggest kind of issue around modern financial markets.
Yeah, and the arbitrariness of it, where everyone who's designing an algorithm right now is designing it to maximize the return. So how do you place an order and buy, or how do you provide liquidity and market make and buy and sell at different prices to maximize that return? But if you do it exactly this kind of way, then you're a criminal. But everyone else is. I mean, it just seems like such a thin line, and a line that would be impossible to navigate for the creators of those algorithms too. I mean, how would you know if you're over the line or not? You can't share your technology with a regulator and get a pass ahead of time, that's for sure. So it just seems extremely arbitrary to me.
Well, yeah, and I think what's interesting, or an interesting contrast, is that obviously for day traders and for people like Nav, they just don't have the compliance people, they don't have the relationships with the regulators or with the exchange to design their trading strategies in a way that pass muster. Whereas if you're, a big HFT firm, you know exactly where the lines are and you sail on those lines, but you know that, what you're doing is on the right side of the law. Even if you were to explain it to someone, as you say, it wouldn't sound very different to what Nav was doing. And then if you do get in any trouble, well, you know what? You've got great relationships with the regulators, plus worst case scenario, you've got the best lawyers in the world. So if you want to beat the game, you have to be able to affect the game, and you have to know the game inside out. To do that, you have to be on the inside and not the outside.
Yeah, which is unfortunate, because how far removed is that from the actual skill? I mean, forget about the skill of investing, but even the skill of trading.
Yeah.
So big news. I just read that you got a movie deal for the book. What should we expect? When, is there a movie in the works? Congratulations on that. That's incredibly cool.
Thank you. Yeah. Amazing. So Dev Patel, the actor from Slumdog Millionaire and a bunch of other great films, he had read like an early treatment of the book, and he actually grew up in West London, not a million miles away from Nav. They're almost exactly the same age, and he just loved the story and was just so into it. And so he, signed on to executive produce it, and then a production company have come on board, and there's now a screenplay. I actually was on the phone to the company earlier today, and so who knows, but it looks quite likely that it's actually going to happen, which would be amazing. I mean, who could imagine Dev Patel playing Nav on the big screen?
That sounds amazing. Yeah, I would line up to see that on the first day, filming about the flash crash. So congratulations on that.
Thank you.
I really love the book. I want to close out with a question that I ask every guest as my closing question, which is more personal, less about the book and high frequency trading. But tell me an obstacle that you've had either in your personal life or your career that you've either found a way to work around or persisted through.
Well, I am going to relate it back to the book. And one of the big challenges of it was that I didn't get access to Nav. When I embarked on the whole thing, I had a link into him, and I knew that he wanted to tell his story. And I knew that writing a book takes a couple of years. So I thought I'll embark on this thing. And eventually, at the time, he was still working with the US authorities to try and build other cases. So I thought that will resolve itself and I'll get access to him. And then gradually, you're doing it for 6 months and 9 months, and I still wasn't getting access to him. And there was a point where I just really thought, I don't know how I'm going to be able to do this. However, the good thing about Nav is that he was such a odd and interesting guy that everyone who'd ever come into contact with him, from his schoolmates to his university folks to the people, to the people at Futex where he started his career, to his brokers, they all had stories to tell me about him and they all remembered him. So I was able to build a really, strong sense of him and what he was up to and what he was doing. And then I remember one day I was Googling around the story and feeling very despondent, and I stumbled upon this post, and it said, it's in the book, but it talks about, has anyone else noticed that the S&P E-mini is completely corrupt and people are basically like, it's just full of spoofing and full of other types of corruption, and the little guy doesn't stand a chance. And it turns out that I had stumbled upon Nav's forum posts, and there was like hundreds of them. And it was just him describing in his own words how he saw the market, how he saw spoofing, what he thought about a number of different things. And it really just sort of buoyed me. And to cut a long story short, by the end of the book, I gathered so much information that I did manage to, as well as sort of seeing Nav at various court hearings and stuff like that, I did manage to actually then go through everything that was in the book with him via a third party and get his input into the whole thing and sort of change things to reflect his point of view. So, it's, I hope, testament to the fact that I've been able to build a decent picture, that nobody's really raised it. But I can tell you that was a real stumbling block through getting the book done, especially at the beginning.
Yeah. I mean, that's, when you think about something like the flat, it's such an esoteric event that, well, how do you personalize it? How do you find those characters and make it more human and talk to them? And I think you did a great job. So thank you for joining me on the podcast. The book, again, is called Flash Crash. It's available at every major bookseller, and it's available on audio if you're lazy and listen to your books like I do. So thank you again, Liam, for coming on. Thank you to the audience for giving us your time and attention, and we'll be back with a new show next week.
Awesome. Thank you, Phil.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.